Well, hi there, and welcome to Connect, the weekly podcast of the California MBA, featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Susan Milazzo, CEO of the California MBA, and I'm very happy that you can join us today. Before we get to today's guest, I'd like to thank our Connect podcast sponsor, Incelerate.
Thanks, Susan, and thanks for listening. This is Josh Wren, CEO and founder of Incelerate. We're grateful for our partnership with the CMBA and are committed as a company to help lenders close more loans. We do this with our customer experience platform that has a CRM, lead management, marketing, automation, robust content library, desktop and mobile applications. We do this to help you engage and stay connected to your current borrowers, referral partners, past borrowers, and potential new ones. If you want to find out why we're the fastest growing CRM provider in the mortgage industry, please reach out to us and ask for a demo.
Okay, thank you, Josh. And that brings me to today's guest. I am very pleased to welcome to Connect Gary Bechtel with Red Oak Capital Holdings. Good morning, Gary.
Thank you, Susan. Thank you for having me.
Yeah, so I always like to start our podcasts out with just a little bit of background. It's always very interesting to hear how people got into the industry. So how did you land in this crazy business?
Yeah, well, it's a crazy way. So before I got into commercial real estate, I was in a completely unrelated field. I was in the marine industry, not the Marines with a gun, but the Marines as in yachts and what have you. In my youth, I used to do a lot of competitive yacht racing. I was very fortunate to compete at a pretty high level. Did some America's Cup stuff, did a couple Olympic campaigns, did a number of national and world championships. So that's what I was doing before I got into this business. But I was looking around and I was seeing, all these guys that I was sailing with or sailing against, and I'm like, these guys are doing really well, right? They're making pretty good money. They own these yachts. What's the common denominator here? Well, the common denominator, they were all involved in some aspect of real estate, residential real estate, commercial real estate, development, finance, sales, leasing, et cetera. And I'm like, well, I can do this. I'm just as smart as all these guys. So at the time, I was sailing with a gentleman named Jim Wormington from Wormington Homes. And, I was kind of imparting this information onto Jim. And he's like, well, I'd be happy to sit down with you and, explore it. And, maybe I can make some introductions. So that's how I got in. Jim Wormington, was kind enough to make some introductions, set up some meetings. And one thing led to another, and here I am, 36 years later.
Wow, it's all about relationships, right? It's like who you
Always
know
is.
and getting
Always
in.
is.
It's always that way. It's always that way. So, Gary, you and I have known each other for several years, and recently you joined Red Oak. So I'd be interested to know kind of what drew you to that company.
It's interesting, right? So I have been depending on how you say it, right? Fortunate, unfortunate. To be involved in the building, expansion, retooling of platforms over the years, be they mortgage banking platforms or specifically probably the last 22 years or so on the lending side. So I was drawn to Red Oak. I was, at the time, I was president of Money 360, and I'd spent the last 5 years building that business from, I got there in August of 2015. There were 6 of us. They had done about $25 million of total volume, prior to my getting there. And we had a pretty good run until COVID hit. We had done over $1.8 billion of total fundings. We had done successfully a couple of CRE CLOs. We had grown the business from 6 people when I started to 39 or 40 people between the production side of the business and the fund side of the business. So it was a good run. And then COVID hit and the business stopped, as did a lot of businesses at that point in time. So we were actually interacting with and had been interacting with Red Oak prior to COVID hitting, sending them loans or they were sending us loans, et cetera. So I knew the guys at Red Oak already. And when we essentially exited the market, they circled back to me and said, look, we want to do what you did at Money 360. Would you be interested? So look, long story short, as difficult as it was to leave Money 360, because that was, that was my baby. I mean, the analogy I use with 360, and I, it's a great business. I still have friends over there. I wish them well. But the analogy that I'll use with Money 360 is it's a lot like taking your kid to college, right? You watch them be born, you watch them grow up, and one day you drive them to school and you drop them off and you drive away and you look at it in the rearview mirror and all you can do is wish them well, but you really can't, you don't have any effect on the business anymore. So it was tough to leave, but it was the right decision for me for a bunch of different reasons. But it was really that I wanted to take that last step up the rung and become a CEO and be able to impart my direction and knowledge that I've gained over all these years in building, yet another business, right? Glutton for punishment.
Right.
And it's been fun. I mean, it's not without its challenges. Any business that you build has its good days and it's not so good days. But it's been a good run. I just celebrated 2 years here. We've doubled the size of the company. We've gotten great traction in the business, and that's a testament to our employees and the people, some of which work for me at Money 360. So clearly they are gluttons for punishment to come back and do another tour of duty with me. But
they knew what they were getting into.
Yeah, right. Well, it's kind of a known, right? It's an unknown versus an unknown. But yeah, it's been a lot of fun. But what drew me to it was quite honestly, it was we had done, I think I got into Money 360 where it was pretty self-sufficient and operating, and it was kind of it wasn't pooping its diapers anymore. It was riding a tricycle and getting along pretty well. So I was looking for the next opportunity, and again, we knew the Red Oak guys. I knew the Red Oak guys from my dealings at 360, and so after talking to them and seeing what they wanted to do, and which is consistent with what the Evan Gentry, who was the CEO of Money 360, brought me on to do there. There I am.
That's great, and congratulations on such a big success in just 2 short years. Doesn't seem like it's been 2 years, but darn it, it has.
Time flies when you're having fun. I mean, who would have thought you're going to take over a business right smack in the middle of a pandemic?
Oh my gosh, right? Had you known, my word. And to have that kind of growth, I mean, and the last couple of years have been busy. 2022, we're entering very, very tough market. What asset classes do you see faring maybe better than others over the next 12 months?
Look, the golden children continue to be multifamily and industrial.
Yeah.
And I think that's a trend that's going to continue for a bunch of different reasons. But I've been actually pleasantly surprised at how fast hospitality rebounded. I really thought the hospitality was going to be a bloodbath, after what happened during the early days of the pandemic. And even retail, set malls aside, set outlet centers aside, because that whole business has changed pretty dramatically, and it was already changing before COVID hit. So, we focus on the core food groups, and that's always kind of, we're not doing specialized properties. We're not doing bowling alleys or land or something like that. And there's plenty of guys in the business that will do that, and that's their niche. But we try to focus at Red Oak on the core food groups. So the office, retail, industrial, multifamily storage, manufactured housing, mixed use, and hospitality. And so, and we're lending nationwide, and we're lending in, primary, secondary, and even tertiary markets where it makes sense. Every deal kind of has to stand on its own. But yeah, I think to answer your question, I think industrial and multifamily will continue to be the darlings. There's some great opportunities in self-storage and manufactured housing if you can find them. That's just a very different beast. Office clearly has experienced it's good and it's bad during the pandemic. The urban markets, the downtown cores have experienced pretty significant changes, and that's, I think, still ongoing, by the way. Most of the office that we've done has been in suburban markets, and that actually outperformed urban markets during the pandemic. So I'm happy of where we are positioned in that space. Retail, it really depends on where it is and what it is and who the tenancy is. I mean, the the smaller retail deals, excuse me, haven't been as affected, I guess, as the malls or the outlet centers, et cetera. You know, you are somewhat Amazon proof, as it were, if you're a nail salon or a, you know,
Right.
a small retail establishment versus a big box retailer, right? So those actually perform pretty well. I mean, setting aside that, you know, a lot of those businesses didn't make it through COVID, they couldn't operate through COVID, et cetera. But the space itself, that asset class, I think is done pretty well given everything that's gone on. But you know, the markets overall are pretty strong. I mean, clearly we're in a different time now with where interest rates have gone and where, you know, the inflationary pressures that you know, most sectors are experiencing. But the short answer to your question is multifamily and industrial are, to me, are the darlings and will continue to be the darlings.
Yeah. How is Red Oak differentiating themselves from your competitors?
Look, it's a tough market. There is, you know, pre-COVID, I did a survey of bridge lenders, which is the space that we operate within, right? The short-term, generally speaking, transitional real estate product. And when we went down to MBA in 2020, there was 364 bridge lenders, from the local hard money guys to the Blackstones and Starwoods of the world and everybody in between. I mean, I think within the space that I was operating at that point in time, the kind of the $3 to $30 million space, there was almost 200. So it's hard to differentiate yourself. I mean, I think the biggest way, and COVID wiped out a bunch of those people, by the way, but there's been a lot that have come back into the market, you know, since, you know, 2021, you know, and even 2022. How do we differentiate ourselves? So we're what I'll call a small balance lender, right? We're 1 to 15, maybe $1 to $20 million lender. Again, we're operating in smaller markets, so a lot of the core bridge lenders, especially the ones that are using the CLO as an execution, they want to stay in the larger markets, you know, the top 50 MSAs or what have you. So, you know, we're gaining business, or we gain business by going into these smaller markets, again, suburban office or retail or multifamily or what have you. The other way that we've kind of differentiated ourselves is that because most of the deals, if not all the deals we do, typically have a value add component to them, we'll stretch on the loan to cost going in, LTC going in, so long as we're still underwriting to a traditional loan to as stabilized value, right? So if I go to whatever 85% loan to cost going in, which is pretty high, right? We're essentially providing an equity component to the borrower. We're still going to underwrite that transaction to a 65 to 70 to 75% loan to as stabilized value. And honestly, we just look back at what we did when, you know, when I was representing life insurance companies or banks or credit unions, right? We know the perm market, so we're going to size our loan to make sure that a permanent lender can come in and take us out. But we'll stretch going in so long as we can make sure we're getting taken out. Because it doesn't do me any good to make a loan if I can't get taken out of that loan, right?
Right.
Yeah, I think what differentiates us from all the other bridge lenders that are out there, it's not the cost of our money. If you know, I don't want to sell just on price. That's a losing proposition. So we typically sell on structure. We typically sell on a little higher leverage, and we absolutely sell on service, right? We, again, much like we built at Money 360, we have some of the best people in the business, and not to degrade any other company that's out there, right? But I've always believed in hiring very seasoned, very experienced people, and I think that helps when you're making the loan, you know, in the origination and the underwriting and the closing of it. And it's probably as true or maybe even more true in the servicing of that loan, because these loans, again, are going to have ongoing construction draws. So your servicing and asset management people have to be top notch. So it's great the guy got a loan from us, or the lady got a loan from us, but if they can't get a draw so they can put a tenant in or do their rehab, what good's the money?
Right.
We don't set ourselves apart with pricing. We set ourselves apart with service and people in service, and how we, you know, interact after the loan is funded.
Yeah, having the benefit of all those seasoned professionals that have been through so many different cycles and markets, and, you know, kind of, you know, benefiting from that over the long run, it's gotta be a big plus for Red Oak. You know, Gary, as you know, our association, we represent both residential and commercial mortgage bankers. And really, since the financial crisis, we've just seen this ramp up of technology on the residential side. But I really feel like in the last couple of years, I'm seeing a lot more technology for commercial real estate. Can you talk with us a little bit about how, you know, the adoption of technology in the commercial space is working for that side of the industry?
Yeah, you know, commercial has always been slower to adopt technology, and honestly, you can never write an algorithm to do what we do, like you can in the residential space, right?
Sure.
This is still a between the ears business, which again is why I've always hired experienced people, because they've got those years of business, being in the business and doing a lot of deals and seeing a lot of different structures, et cetera, right? Now, look, that said, I mean, when I was in a business many years ago, late 90s, I worked for a company called Belgravia Capital Corp. We were bought by a publicly traded company called Finova. We developed really one of the first commercial LOSs. I mean, we did it internally and at substantial cost back in the day. But that basically took all of our Excel, our Word, our Microsoft Access, and put it all into one big platform. Because look, we could do it. We were a publicly traded company. We were doing, you know, $4 or $5 billion a year in volume. So we had the ability to be able to do that. But I think that was the kind of the first commercial loan origination system, LOS, out there in that space. And that system, by the way, is still around today. It's called North Shore Systems. And there's been a lot of other platforms that have come into the business over the years. A lot in the CMBS space, some in the commercial space. But you know, as I said, this is a between the ears business. You can't build an algorithm to do this business. Technology is good in that it allows you to be much more efficient and much more transparent. So that's where we utilize technology. I mean, at Money 360, we built our own proprietary technology platform called 360 Live. Great business. I mean, great tool, right? Made our business very efficient. And we have a system here at Reddo called ROC, Reddo Capital Exchange. But technology is not going to replace people making decisions, right? It's not going to replace the custom suit nature of a commercial real estate deal. It's very helpful in making you more efficient, so you have less bodies doing the same volume. But it's still a between the ears business. And so, yeah, there's probably a dozen technology platforms out there that I've seen, been demoed, have looked at. But it's harder to do technology within the commercial real estate space as it is in the residential space. That's a much easier proposition.
Yeah.
We use it. Everybody uses technology to some degree, but it's not ever going to replicate, you know, the gray matter between the years.
No, and yeah, that consumer, you know, the consumer lending that residential lenders do is just a different animal, but it just is, it's interesting to me to see, at least from my perspective, all of these technology companies popping up on the commercial side. So it'll be interesting to see kind of where they land here in the industry.
Yeah, I'm sure we'll talk about this. We're actually going to, I think there's a technology panel at the upcoming Western States Conference, which plug for Western States, you know.
Yeah, not too much longer. You know, you've always been a big believer in mentorship and giving back to the industry. I know that's why you wanted to join our leadership, so you could give back. Can you share with us who've been some of your mentors in your career?
Yeah, you know, it's well, clearly Jim Wormington, who got me into the business, and I, you know, depending on the day, thank him or curse him for that. So I'd probably say Jim was my first mentor. My first boss in the business, when I started back in '86, I worked for the Allison Company, and I moved down to San Diego. I was living in Orange County, moved down to San Diego, and worked for a gentleman named Fritz Swinehart, who'd been in the business for, you know, an extended period of time. So I'd probably say Fritz was my first mentor, because I literally didn't know, you know, I barely knew how many square feet in an acre, right? I didn't know. I had no presence in commercial real estate. I had to learn the business ground up, because I'd been in a completely different industry. I went from the top of that field to the, you know, to the bottom of commercial real estate lending as an analyst. And so Fritz, you know, really helped me learn the ropes, and yeah, I'd say he was my first, other than Jim, and really probably my longest mentor that I had in the business, and really helped give me a better understanding of how you want to do business and how you should conduct yourself. And that's what I've tried to do through my entire career.
It's always nice to look back at those people who've helped us, be successful in our careers and let us do something that we love. So it's always nice to think about them.
I'll tell you a funny story. Funny, it's not a story, but so I worked for Fritz in 1986 through, I don't know, 89. When I moved up to Orange County to open an office for Pacific Southwest Realty Services. And maybe it was 90, whatever. Years later, when I was with Guy Johnson at Johnson Capital, I was COO at the time, Fritz came to work for me, came to work for us. So full cycle, right?
You never know. Yeah, full cycle. That's for sure. That's for sure.
Which is, again, why you want to always conduct yourself. It's a relationship business, as you said earlier.
So you are chair of the 2022 Western States CREF Conference, again, back at the beautiful Aria. You want to share with the listeners a little preview of what they can expect at the conference this year?
This is going to be a lot of fun. I mean, I was chair last year and really had a lot of fun. So again, was happy to be able to be chair again this year. It's this is the largest event other than Big MBA in the country. It's the biggest gathering of lenders and mortgage bankers. And I think it's been going on 25 years. I've been going to it ever since I've been in the business, Susan. Mm-hmm. But I think we're going to have a pretty good agenda this year. As I just touched upon, we're going to have a technology panel, which we have not had before.
Right.
And so I think that's going to be interesting. We're going to do a marketing panel with what I'll call the new blood and the old blood of what's worked historically from a marketing standpoint. How do you get your brand out there? How do you generate deal flow? How do you, if you're a lender, how do I get my message in front of people? But also we're going to have some of the younger folks that are newer in the business, because they've got a different take on the business, right? We all use social media, but that's their world, right? They know that upside and up one side and down the other. Whereas, old guys like me, we're more, we're going to use email, or we're going to use this. So I think we're going to get a good blend of the two different approaches to the business that I think is going to be conducive to people learning. We'll have what I'll call our traditional side of the business, where we'll have, Mary will come in and speak big macro economic picture. Hassam Naji has agreed to speak to us a little bit, and then again, I'm looking forward to this, as I did last year. I'll have the opportunity to sit down with him after his presentation and do a little fireside chat, as it were. And then we'll also do some panels on structured finance. We'll do some panels on permanent finance. So I think it's going to be pretty well-rounded. A lot of different topics, a lot of different people sharing their views, sharing their experiences. So I think it's going to be great. I was really happy with the Aria last year. I mean, as much as the win it was a great place, I think the Aria is actually nicer and more conducive to this conference. It keeps everybody kind of in one spot.
Yeah, so that was a nice, I think, a nice switch for us. And we are looking forward, of course, to being back at Aria here in just a couple of weeks.
Yeah.
And you also, this year, you've been a member of our board of directors, but this year you joined our executive board. Can you share with our listeners why you volunteer your time and why you would say it's important to support the California MBA?
Yeah, so again, this gets back to giving back, right? And whether I'm giving back to people within my company or people outside of my company, this is a business that has given me, a great opportunity, and it has been very good to myself and my family. So whatever I can do to give back, whether that's mentoring people that are new in the business, whether that's donating my time to other organizations like the California Mortgage Bankers Association. I mean, to me, California Mortgage Bankers is the preeminent force in real estate, whether it's residential real estate or commercial real estate. I mean, it's not just the conferences that we do; it's the advocacy we do. It's the legal work we do up in Sacramento, and so I was excited to be able to join the board, a couple of years ago, Susan. I'm very excited to have been and very honored, by the way, to be asked to be on the executive board. So I'm looking forward to that as well. But I think the more we can give back, especially as we get deeper into our careers, to an industry that's been very good to me and very good to most of the people in the that are part of the California Mortgage Bankers Association. I wish I had more time to spend on it and devote to the other committees and what have you. But it really benefits our industry. I don't think people realize out there how much you and the other members of the CMBA staff and our council and our legislative guys that are beating the streets in Sacramento do to further our industry and make it so we can actually operate, given a lot of the roadblocks that our legislators seem to want to throw up in our industry.
Yeah, they're never without a bunch of ideas.
Right? They just, unfortunately, don't always think them all the way through.
Yeah, well, that's our job is to educate them. So thank you.
Educate them and bring it to their attention. Like, did you really think about this?
I know. Well-intentioned, but it's like, it's not really how the industry works. Let me kind of share that.
Yeah, no. Again, I'm very excited to be both on the board and now on the executive board and give back to an industry that's just been great to me and my family and look forward to doing it for many years to come.
Excellent. Well, I really enjoy working with you, Gary, and thank you for your support. Well. Thanks for sharing with others why they should also support the California MBA. And I will see you in just a couple of weeks at the Western States CREF Conference.
Yep, I will be there.
And thank you, everyone, for joining us on today's episode of Connect. To visit see all of our episodes, you can follow us on our YouTube channel. We're also available on Apple Podcast, SoundCloud, and Spotify. That's it for this week, and we'll see you next time.